Hello, welcome. My name is Brian Gregory, and I'm the president of Aldridge. For those that aren't familiar with us, we're an MSP based in Houston, Texas. We've got locations in Dallas, Austin, and Seattle. I'd like to thank you guys for all joining us today. Thought leadership has been something that we've been a part of our lives and a part of our outreach that we like to do. And this year we've had to get a little creative with and do things differently. A lot of the industry events have changed, and obviously not as much face-to-face presentation, so wanted to put together an M&A series with some of the experts in the industry and really talk through what you all are asking about M&A and the challenges you're facing. And so we did an event back in August, and we had a lot of great questions, but a lot of the questions that we got were centered around valuation. So we wanted to do the second part of the series as a deep dive into that. Part of that, we're going to look at the balance sheet that companies have. We're also going to run through a couple of models and scenarios of companies that are valued with what we generally see and the different ways that we approach that. So it's going to be a very interactive session. We've got some planned content as I discussed, but I want to make sure that we answer the questions that are important to you. So please don't save those questions to the end. Ask those as soon as you think of them. I'll moderate those questions to the person or people that make the most sense to answer them and bring those up when they're appropriate. Also, after the event, you'll get a survey from us. Please take just a couple of minutes to answer that. We want to do more of these events, but we want to make sure that we're catering them to the topics that are most relevant to you. So just take a few minutes, answer those for us. All right, so without further ado, just want to quickly introduce the panelists that we have. We have Rick Murphy, the CEO of Cogent Growth Partners. We have Scott Hamlin, Senior Executive Coach at C-Level Operations and also the founder of Packet Drivers, and Patrick Wiley, the CEO of Aldridge. So gentlemen, let's just go around real quick. Tell us a little bit about yourself and the company. Rick, let's start with you.
Hi, everybody. Rick Murphy, founder, CEO of Cogent Growth Partners. We're going to be 11 years old in February. We are a buy-side focused M&A advisory firm doing exclusively work in the IT services space. We've done over 135 closed IT services deals in our history. Just closed 2 last week, actually. The M&A space is very hot, still is, and looking forward to talking about it today.
Very good. Scott?
Hi, everybody. I'm Scott. I am a former owner in the MSP world. I started my business, Packet Drivers, in 1998 and sold February 1st, 2016. I remember that date exactly. Sold to Aldridge. Took some time off, started doing some part-time consulting, coaching, as we call it, at C-Level Operations around finance, helping MSPs to first get your books in order and then be able to analyze your business and move it in the right direction in terms of profitability. And now I have 2 roles. We actually have a back office service where we are doing invoicing and bookkeeping and those sorts of things for MSPs. So kind of went from part-time to almost full-time now. So loving it.
Very good. Patrick?
Hello, everyone. I'm Patrick Wiley. I'm CEO of Aldridge. So we're a managed service provider, technology solutions provider. We're based in Houston, Texas. And we've grown our business over the last, so we're a 36-year-old organization. But certainly in the last 10 or so years, we've grown mostly through M&A. And so we've done 13 deals, one of which was, as Scott mentioned, his company, Packet Drivers. And so we've expanded to include Dallas, Austin, and then Seattle, Washington. So got a good bit of, I think we've made every mistake you could possibly make in M&A, less so maybe on the deal side because we had good advice from Rick and his team. But so looking forward to today's discussion and sort of revealing some of the secrets behind, the secrets that are really not secrets behind valuation.
Very good. Well, to kick things off, Patrick, I know you and Scott spent some time putting together a worksheet or a workbook, if you will. Do you want to start with that, kind of talk through some scenarios, and we'll take questions as we go. Please don't hesitate to ask those questions as they come up.
Yeah, sure. Thanks, Brian. So what we did is we put together a model that looks at what I would call a very average MSP. So we did, it's about, you can see here, and so what you're looking at on screen right now is really just a sort of high level profit and loss statement for about a $4.1 million MSP. So it's about $345,000 of revenue annualized to that 4.1. And we've got all the factors with cost of goods here. And so I'll call your attention to sort of the gross margins of the business first. So I'll just scroll down there. So this is, I built this model based on the average type of business we see as we're looking at candidates. And so usually it's about 18% hardware software gross margin, about 31% in terms of cloud resale, about 25% in time and materials work. Yes, there's still time and materials work inside generally every MSP we look at, not 100%, but many. About 40% margin in project or consulting services or other professional services, and about 43% in managed services. And when you put all those things together, it brings about 12% to the EBITDA line. And so that's what's done here. And so our intent was just to sort of give you a look inside an average $4 million MSP and how we as a buyer would treat that from a valuation point of view. I know that everybody, go ahead.
I was just going to interrupt you. The revenue mix that you did and the EBITDA percentage, is that truly an average? Is that a well-run company? Where does that fall on the spectrum?
I would say it's normal. I think if you look at, service leadership post best-in-class numbers, I think financially you're not looking at a best-in-class. You're more looking at, sort of that median quartile probably more frequently. And so I'd call it average, not financially, from a financial point of view. There's lots of different factors that go in it, but strictly from a financial point of view, I'd say average. So whenever valuation comes up, the thing that we hear about the most out in the market is what multiple can I get? What multiple did someone else get? What multiple? And it's almost always referring to multiple of seller's EBITDA. So in this particular business, we've got the seller's EBITDA right here at just under $500,000. So that's that 12% of the 4.1. And so the question that most sellers have is, how many turns or times EBITDA can I get in a purchase price? Deal structure, I just want to touch on it very briefly, is a whole different animal, probably one that we'll do another entire webinar around. So we're really just talking about not necessarily how this is paid right now, but what the total amount to be paid might be. So as we look at $500,000 EBITDA company, and you take this buyer's perspective, it may not be representative of 100%, and Rick could probably talk to this a little bit more since he knows a lot more buyers, but we're interested in making sure that we get our investment returned at a maximum of 5 years. There's a lot of change in this industry. There's a lot of change in technology. Businesses like ours tend to reinvent themselves nearly on a 5-year cycle. So looking beyond 5 years for a return on buying a technology solutions provider or a traditional managed service provider is really hard to do. So if we had to value this business exactly as it is, and there's no add backs, which we'll talk about in a little bit, we don't look at synergies. If this was just a one-off thing, the maximum amount that we would be willing to pay is 5 times. So because that means 5 years. So if we assume that it operates just as it is, in 5 years, making $500,000 a year, we'll get our return back. And then we've got, we'll continue to operate the business. Rick, I don't know if you want to give a little bit more color or perspective on what you see other buyers doing.
I need 10 times. I'm not going to sell. So and we've heard that before. So that is a good setup. It's really the difference between the buyer's perception of what they're looking for from a return on cash, on the cash they're spending, and the seller's perspective on the value of their business, right? And a lot of sellers or potential sellers, most of the companies we talk to aren't really sellers when we first talk to them. They're contemplating whether they're going to sell or not, and why should they sell. And there's lots of other reasons that go into all of that. So again, that's a webinar for another day. We're just talking about purely from a valuation perspective. This business looks like it generates about $500,000 a year. And there's other things that can come into play, which we'll talk more about as the conversation goes on. But just strictly speaking, most of the multiples people hear about are from a seller's perspective, and they're either broadcast by the brokers or people on the sell side. because they're the ones that have the perspective. You rarely, if ever, hear of a buyer actually publishing, hey, I paid this much for the company. Typically speaking, when you hear someone that might have in fact gotten 10 or 12 times or 15 times their EBITDA on a trailing basis for their business, and it's possible, but it means that the buyer's doing something with that business. There's new sales, there's headcount trimming, there's divisions that might go away. A lot of things happen. If you look at, I think ConnectWise is a really good example of that. When ConnectWise was sold, what Arnie got on a trailing basis for the way he ran the company was one number. And publicly, they pretty much announced a lot of layoffs and stuff happened in the business, and they changed the business so that the buyer could benefit from that. And that's what happens in transactions. So there's just variations on the theme. So what we're talking about today is a buyer's multiple. It's not the seller's multiple. The seller, we might be running this business at $500,000 is kind of the way it was. So it's a good sort of median example. But what are we going to do with the business as a buyer? Why should we buy this business at all? All the other things that go with that. But at the end of the day, I think we're focused today on a buyer's perception of a multiple and teaching you about that and thinking like a buyer as opposed to a traditional trailing seller's multiple on a trailing 12-month basis. Make sense?
Yeah, and I think we'll show you sort of how the two compare as we get further into the model. But one of the points
I just say for clarification, this is an evaluation of that business running exactly the way it was before, just as part of the setup, correct?
Which is actually what I was just going to say, that occasionally I run across a seller as we're evaluating companies to buy that come to me and say, listen, my business is perfect and the clients love it just the way it is, the employees love it just the way it is. I'm interested in selling and I'm interested in selling to you, but you can't change it. If you start to change it, you'll have employees leave. If the employees leave, the clients will leave. And there's a lot of truth to some of this, and then there's some of it that is emotion and just the way trying to control the future a little bit. And so if I were valuing this business exactly as it was, or a seller came to me and said, no matter what you do, we're going to write into the purchase agreement, you can't change this business, then you'd be looking at a maximum I could possibly pay to keep inside my investment horizon is just about $2.5 million.
I was going to say, we've got just a couple of questions here and another comment. Someone's asked if you could just scroll down a little bit to the gross margin so that they can look at that again. And following this event, on the survey you get, if you want a copy of this worksheet, please just select that option and we'll make sure that we get this out to you as well. Someone's asking about, we're showing 1 year of EBITDA. How many years back will the buyer look for a trend?
It's a really good question. So if you're talking about this buyer, we're looking back is interesting, but selling us on the go forward plan, because to answer the question directly, we look at about 3 years back, but we're really focused on the last 12 months, but we're looking for any anomalies. So if the business over the last 3 years is trending down, it's a very different story than a business that's flat or even trending up. We're really trying to understand the go forward strategy, because the past is interesting, but this 1 or 2 or 3 or 4 good accounts that become really good accounts and have 3-year, 5-year agreements really make a difference in terms of the go forward version of it. So from my perspective, we're a lot more interested in the last 12 to 18 months, but we do look at a 3-year valuation just to make sure or a 3-year history to make sure nothing's changing. Rick?
Let me add one thing to that. So I think that's right. I think most of the buyers we know are going to pay attention to what's called TTM, trailing 12 months, from the last known good month that they analyzed the business. So right now, if we're analyzing a business that had just closed their October books, we're looking back trailing 12 months before that to the previous October, and then to the previous calendar year for sure. And we usually, in fact, go back. Sorry about that. Let me reject that. Sorry. We usually go back 3 years, like you say, and so we have a good financial history lesson. And one of the things you got to pay attention to, whoever they ask that question, is customer retention really comes out, right? So customer retention is a huge thing. You can't just see that in a trailing 12-month view. You're going to be looking at monthly financials, not summary financials. And we're going to go back 3.5 years. In this case, if we were going to look at the company right now, I would do 2/20 October. I go back 3 years from calendar date and pick up 19, 18, and 17. And we're, again, inside the old financials, we're going to be looking at customers, customer retention, win-loss, all those types of things. Sorry about that. Somebody's trying to call me my other lines. So, those things are really important. But from a free cash flow perspective, that history lessons, the company that you ran 2 or 3 years ago is not the same company that it is today. And so, that last 12 months from this, this last 12 months are really important. And then that helps us think about what's going to happen in the next 12 months.
And that last client that you signed that added 30% to your revenue becomes super critical, right? In terms of looking at that client and saying, did you sell it at, $50 a user? You're going to start discounting, right? And so you're going to really want to analyze that big change versus somebody that's steadily adding, right, good clients month over month or quarter over quarter.
Yeah, we'll take, from a what's more valuable to us from a stability point of view, we'll take a business that's not selling any net new business at all, but not losing clients, over one that is selling every month, but losing every single month. Those are really hard businesses to maintain. Now, of course, the very best business, the very highest valuations, where we'll stretch even above our typical, which is a proven 3-year history of every quarter I add $20,000 of MRR every quarter, and I'm doing that every quarter over quarter over quarter. That's the most valuable. That's where you start to really sell us on the forward looking, if you can show a past history of just real sales success.
Unicorns.
Those are unicorns in this business. That is true.
I have a couple of more questions before we move on to the next section. Someone asked what I think is a very good question. Do long-term agreements substantially impact valuation? I'm sure we've got some strong opinions there.
Let me go first. Just had this conversation yesterday. Talked to a company. We call them discovery calls. We had a discovery call with a company out on the West Coast, and doesn't believe in contracts at all. Thinks they're terrible. He doesn't lose any customers, so he says, and I believe him. He's got good customer retention. I believe him. He's even doing a Haas without a contract. Super interesting. I put that in front of 3 of my clients to see who would go, hey, that's really interesting. And a client that I actually thought might not like it and might think that was a bad idea says, you know what, I don't really care about contracts either. I forgot to tell you about that. Here's what our new thing is. Here's how we roll. I'd love to talk to this guy. So it depends on the buyer is the real answer to that. It just depends on how the buyer rolls. Patrick, you go ahead. I'm sorry.
Yeah, no, it's all right. I think from my perspective, lack of contract doesn't necessarily impact the valuation as much as it does deal structure. And like I said, there's a whole nother hour we could spend on deal structure. But if the business is there and it's proven and the financials say it, then we'll value it as such. Lack of contracts certainly puts more risk. Sometimes after you do a deal, you've got 5 clients like, oh, I was thinking of shopping anyway, and now you've made it easy because I'm changing anyhow. So here's our 30 days notice. That really for us impacts deal structure more than it does, and it causes us to shift more risk to the seller than it would if you were locked into 3- and 5-year agreements that scattered out over the year. That we would take more risk in that case.
And that's exactly true. I mean, it's definitely the risk profile and how the risk profile comes back into deal structure. And, again, price, not so much, because it's about free cash flow and how much money the business generates and what can we do with it after we buy it, from a buyer's perspective, and a lot of other factors. Are you staying or going? Are you going to be part of the solution? Are you punching out? There's a lot of different things that happen. So, again, there's more webinars here. We're going to be doing these hopefully every couple of months to keep pounding on this. But yeah, so I think deal structure, risk factors come into play with contracts. If you have contracts and they're not easily canceled, then that's more sticky and de-risking the deal for the buyer.
Now that unless they all expire 2 months after the deal, right? Because then the customers are, well, I'm going to leave versus no contract. Well, I'm going to string it out at least for a little while.
Yeah, that is also a challenging scenario. Spread out throughout the year, getting all your clients on one contract cycle does not help from a risk profile point of view.
Don't do that. Don't do that.
Don't do that. Sign them up when they come. That's for sure.
That's right.
We've got a couple of other questions, but one more I'll ask now. How much of EBITDA makes it to cash flow to inform the payback period? Inform what the payback period is, and EBITDA to cash flow, especially important when an LLC is bought by a C Corp and now has taxes. Curious as to how Aldridge bridges that gap.
I can do it if you want. It's up to
Yeah,
you,
sure.
Patrick.
You can start with it.
Well, you start thinking about this. So again, we do a lot of different deals all the time. The C Corp, S Corp thing we can always take on the side. If you can find me on my website. If you want to ping me privately, I can get a little deeper in that. We can't go too deep on that today. But generally speaking, EBITDA is a proxy for free cash flow in the absence of debt. So if you have debt service and other types of debt on the books and so forth, debt to yourself, banks, capital leases, operating leases, just things like that, bank loans and what have you, the debt service to service all of that impacts cash flow. And that's why you really don't depend on EBITDA to do a pricing of a deal. You really depend on free cash flow. Our modeling that we do at Cogent is all about return on cash. So we try to remodel the business and understand its cash flow. And that's a really great question, by the way. And the tax implication is part of that, right? Because the S with a C and all that kind of stuff and who gets taxed and how you do it also depends on how you structure the deal. And then on the other side of closing that deal, there's a lot of things you can do to tax advantage yourself in terms as being a business. How are you taking money out and so forth. So it would take a half an hour to really get into that question, but that's the shortest answer I can find.
Yeah, and I think in this scenario, and Scott's going to talk a little bit about the balance sheet toward the end of the presentation, because that certainly has an impact. This concept of the average MSP, I should have said up front, the average deal we see doesn't have any debt. Generally, it's just short-term credit cards paid off every month kind of thing. So I just edited the sheet to say we're really talking about free cash flow. I think Rick's exactly right. EBITDA in this conversation is really a proxy to free cash flow, because in the absence of debt, those two are very close to each other. Should we take a look at the next concept here? So assuming you're not a seller who says, sorry, buyer, you can't make any changes to the business at all, and it's perfect and pristine how it is, the first thing that happens is a look at what kind of, and primarily add backs, can be added back into the business. So if you're a seller, you're looking at what things do I run through the business? What things does the business pay for that's on my income statement that aren't really necessary if the buyer is going to run the business? So let's take one example. Let's say the primary shareholder's salary. So maybe you're in this model that I built here, I said the primary owner of this business probably makes $120,000 and really is only working half time in the business. Is only coming to the office 2.5 days a week, and isn't the business doesn't depend on him besides that. If that's the case, then you'd say half the salary comes back. People don't get divided in half, but the buyer can figure out a way to supplement that again, with everything else that's going on. The other things that I see most commonly that are not just way out there are memberships in peer groups like HTG or ConnectWise Evolve, I guess is the name of it now. Those kind of things really accrue to the existing owner's benefit, and that those are not really go forward expenses. So there's a couple of examples, and I wanted to just show you what, and we could talk a little bit more. I know Rick and Scott both have examples of things, sometimes we think things are add backs that aren't, and vice versa. But if you just some simple work here that all that did is really got the value from about $500,000 to $580,000 just by removing part of the owner's salary, some travel, some meals, and peer group expenses, gets this business all of a sudden up to $580,000.
Highlight those, would you, so everybody can see that little column L and the stuff that sort of goes to there. Yeah, there you go. Those are the add backs.
Yeah, so those are the adjustments between what was here and then what we've decided. And I just pre-plugged in some numbers just as examples, and we could change those or talk a little bit more about them. But so I want to just sort of touch on how this makes a difference from both the buyer and the seller multiple. So we got the EBITDA up, or the projected, the forward-looking EBITDA up. So I said that as a buyer, we don't want to pay more than 5 times. That's certainly true. But what we really want is to pay less than 5 times. But what a seller wants is to get more than 5 times. And this begins to show how that can happen. So if we believe in your ad backs, and we believe in the forward-looking, this business runs this way, we can reduce what we pay. So we reduced by a quarter turn, so down to 4.75 times the projected EBITDA. And the buyer is now up to 5.5 times his original EBITDA. So, and the cash prize, if you will, is nearly up by $300,000. So so this is the beginning, and we have one more model to show you where it really starts to diverge. But this is where, to Rick's point, the way the buyer runs the business and the way it differs from the seller starts to accrue to everybody's advantage.
You know, Patrick, are there scenarios where it's the opposite of that? And one I could think of is somebody that pays himself $50,000, draws, you know, $100,000 off the balance sheet in terms of a draw, doesn't want to work in the organization anymore. That number is not going to be 60,000; it's beyond negative 60,000. Correct?
Yep. It can certainly, if you are someone who is running the business and underpaying yourself on the income statement, and you may want to leave the business, but your position is required to be filled by somebody that we have to pay market rate, 100% could go the opposite way. Yeah.
That's right. Right. Which is
another
why
scenario, but I'll be real brief about it. Another scenario, we had a situation, a real life situation where we had a transaction where post LOI, letter of intent was signed and everybody's moving forward. And then the owner decided he wanted to continue working when we had already previously, everybody thought he was leaving the company, and he was going to retire and move on from the company, and he changed his mind. It made the economics untenable, and we couldn't do the deal. Right?
I had a similar real life scenario where, and I see this more frequently where there's businesses with multiple partners and multiple minority partners. You know, the deal was originally presented to us by a broker that said, here, this is great. Here's this big EBITDA number. All the partners are in the ad back column, and we're down the road, and we put together an offer, and everybody's like, yes, this is great. It's working. We're moving forward. And then they would get to the point where they're saying, oh, wait a minute. What about partner 4 and partner 5? They still have to work here. They still need a job. You know, it brings the whole thing to a halt. And we're like, well, just a second. They were in the ad back column. So if you're saying we need them, fine. If we need them to run the business, it is what it is. But then we've got to take them out of the ad back column, and all of a sudden the purchase price goes down. And then that sometimes gets untenable, just very similar to what Rick's saying. And that has happened more than one time to us. So when you're thinking about ad backs, you've got to really be thinking about costs that will evaporate within a very short order once the buyer takes over the business, and don't negatively impact your client relationships, your ability to provide service, and the things that you do to make money.
That's exactly right.
Rick, I know, any more you want to say about ad backs, things you see maybe the opposite way that sometimes try to get included and just can't?
Well, yeah, I mean, I think, you know, the HR is such a big part of that, so I think we've beaten that to death probably, you know, could stand to probably be beaten a little bit more, but, you know, stuff that happens with human beings and the staff is a big part of that. We have seen issues where, and this can be a real deal breaker, especially if you're already in the middle of doing a deal, is where the ownership starts feeling guilty about them reaping the benefits and not sharing it with the employees. And they start giving the employees raises or make raises happen and things happen that change the forward economics of the company, as not a one-time only situation where, you know, I've had owners take money out of their pocket and gift it to, give that as a bonus to employees, but, you know, increasing salaries and otherwise, you know, working with different parts of the company and changing things in the company that are different than what we analyzed when we were doing all of our analysis and all our modeling to make the original offer. That can be problematic. Changing charts of accounts and not having good revenue recognition, which Scott's going to talk about a little bit in a little bit on the balance sheet. I'll save some of that balance sheet stuff for you, Scott. I won't go on that now, but, you know, having things on your balance sheet that you don't understand, and how you're doing cash accounting versus accrual accounting. One of the things we're doing at Cogent is we're actually converting cash accounting into a accrual viewpoint and accrual perspective. So we get a really good gap look at the business and then understand how the cash accounting is going to work on behalf of our buyers, so that it's all, standardized. So, we don't see a lot of people that are gap, clients or otherwise, very few gap people. So that's okay. But just being careful about things like that move. And there's a whole laundry list behind that.
And you should never analyze your business on a cash basis. I mean, there's some cash implications about cash flow. You want to know how you're doing in gross margin, it's always about accrual.
Very good. We've got quite a few questions coming in, but I'll save that to the end of this workshop or the worksheet. And so, Patrick, if you want to keep going on that, and then we can answer some of these before we move into the balance sheet section.
I'm going to go mute for a second and get this headset on a charger because it's yelling at me.
All right, so I've added a third column to the sheet now for us to take a look at. And this is where I think it starts to get really interesting for both the buyer and the seller. And so this is a look at, and it could be forward some, 6 months, 9 months, 12 months in some cases, but this is really taking a look at how are we going to run, how is the buyer going to run the business for real once they apply all the extra synergies that the buyer would get. So I'll give you an example, your PSA system or your RMM, what might be the more expensive of the system. So you get one price per agent on RMM, and we at a higher volume get a larger price on, or I mean a lower price on RMM. And simply by moving from your account to our account, the price could go down as much as 30%. And that's just extra benefit that we get in operating the business that has zero impact to the operation. And so there's a lot of examples like that, PSA, and there's human capital examples too. So you don't need to run 2 accounting departments. You don't need to have 2 full, service desk management folks. So, there's human parts of it too. If you're in the same geography, you don't need 2 offices. There's just a lot of things. And so this is a real deep look at, all right, and here's the buyer's motivation to do this. Because I said we want to lower our multiple. We want our return on investment quicker. And so if we really analyze how we're going to run this business when it's ours, then we take a look at, then we can pay less, but we have probably, to get the deal done, we've got to share some of that benefit with the seller. And so in this last version of the model, that's exactly what we've done. So we're projecting the way we run the business as the buyer that we could take the 496,000. There's been no revenue change. That's a whole nother topic of conversation, but we assume revenue stays the same by just, taking the add backs first and then compounded by the synergies that the buyer gets, we're now up to about 800,000 in revenue. And so that allows the buyer to now come down nearly a whole turn from 5 to 4, but the seller goes up nearly a turn and a half. And this is just one model. There's clearly some negotiation and back and forth and who gets what benefits and how much do we share, and that going forward. But when you start to hear about the people that are getting 6.5, 7 times multiples, usually those are a little bit larger business than this. But we wanted to show a model of how that can happen and how the buyer can also still afford to do it, but actually afford to do it and continue to do deals by having a lower return on investment. So the very best, what's done here in this buyer benefit or the synergies, this is really the best case scenario for everyone. And so just a quick look at how it looks. So we're saying in this same business, we'd run at 19% EBITDA, and we do that by getting managed services, while not quite the best in class, but up there very close. 4% gain in pro services, big gain in TS, generally because we've got we can maintain a smaller bench and have a lot more options, a lot more clients across that same size bench. Cloud resale up a little and hardware up, a reasonable amount. And so that's where the buyer and seller multiples diverge in a very positive way. And like Rick said, buyers like us, we don't publish this multiple number. This is probably this is sort of the peak inside what that could look like. But But that's sort of how a deal can come together in the middle.
In this
Well, there's
case,
another thing that happens there. Oh, go ahead, Scotty. Go ahead. Sorry about.
I was
Yeah,
going to say,
okay.
in this case, managed services, you have a large reduction, right? In I don't know if it was W2 COGS, right? That's assuming you can bring your efficiencies to their operations. But if they're, right, because gross margin in managed services isn't just a reflection of your efficiencies and what you're paying people and your hard COGS, it's also a function of price and other things. So if the person you're buying is charging $50 a user, you're not going to be able to save that. That's probably the right amount of COGS they had in there for the price they sold it. So gross margin, as we talk about, is not just a function of that. And so in that case, you're not going to be able to, right, to reduce it by that much.
Yeah, that's certainly something we do during diligence. If we find that, we just have terribly underpriced contracts and no method for escalating the cost on them, then we wouldn't be able to get this. We're kind of back to the middle model a little bit more, which I guess is an argument for reminding everybody that the more you sell at a cheaper price does not necessarily bring your valuation up. It's selling reasonable amounts at a good price, a win-win price.
Yeah.
And Scott, I know you, especially the structure of your deal and the way that we approach packet drivers and Arterian, there were quite a bit of synergies there. I know you planned for that going into it. Do you want to elaborate any?
Well, it may not even answer your question, but I always tell people you got to be mature about running your business, and you have to be really sober about selling it. And Rick could speak to it better. I don't know how many people are really sober about selling it, especially, and these things speak to it. Oh, I'm going to get 7 times EBITDA, but you can't change anything. That's not a sober look at your business and understanding it. We had quite a few synergies, and we expected, right? I went into it expecting we were going to have to cut people, and they were great. I have the best team in the world, but we do what's best for the organization and for the employees, and so. There were a lot of synergies around that. We did have, unfortunately, some people were let go, probably on to better opportunities, as I always say.
Oh, Rick, I think you're talking, but we can't hear you.
I muted myself. There you go. Sorry about that. So, this also points out, and I think everything you said is accurate. What this also points out is the art of the bargain also, because while everything in column O and P in the green column, is it looks like a more improved EBITDA number. We could pay a higher purchase price by a whole bunch compared to the orange column, and it really matters to the seller in terms of the seller's multiplier, and it certainly helps the buyer from the buyer's multiplier. So what's also interesting there is the risk or de-risking of the green deal and how that would impact structure in a positive way for a seller as well. So I think one of the biggest cautions is, not begrudging the house their cut and not having, trying to squeeze every last nickel out of a deal or out of the buyer. And the buyers, if you're a buyer, you're not trying to squeeze every last nickel out of the seller. That's just not the way to roll. We try to be really neutral with a little draw to the buyer, right? In a golf analogy. I mean, you want to do what's fair and square. I love doing the Warren Buffett quote. I'd rather pay a fair price for a good company than a good price for a fair company. And that's the way you should run your business. And if you're running your business that way, you're taking money out of your business now. You're running a healthy business. You're putting money in your pocket and your partner's pockets, and your employees are well paid. So I mean, just running a really great business, rather buy that business.
Yes.
Fixer-uppers can be fun, but you got to see how much of a fixer-upper is it, and what needs to be fixed. Right? I think Scott touched on, the rate issues. That's tough to fix. I can tell you that if you see a really high touch business where you're constantly talking to customers every day and you're visiting the office and you're really high touch, and a company that's mostly remote and doesn't do a lot of high touch, those customers are not going to feel like they're being serviced. That's an issue. That's a real problem. We try to identify that really early. And those things come back into the money part too. Those are more operational issues, but it does come back into how the risk works and what I can make happen for the seller and how that's going to work for them. And then again, how much do we believe these numbers? We use this every day. How much do we believe that 805? How much do we believe that 580? And is it really the 496? Which business are we buying, right? and how much of this is going to come true. So the very last minute, the very last day before you're going to make a letter of intent and put a price point in it, maybe you have a little wiggle room to do some negotiating if you need to. Boy, how much do we really like that 805 number? Can we hang our hat on it? So we talk about that all the time. Fair enough? Go ahead. Keep going, Scotty.
Well, one thing I was going to say, Patrick, I think you should tell me this. The buyer wants to pay you not just, let's say there's an earnout portion of it. They want to pay you all of your earnout plus some, right? Because the deal is actually, so, right, it's the motivation is a win-win. The buyer's not trying to screw you out of something. Just like if you have a salesperson, you want to pay the salesperson a whole heck of a lot of commission, assuming you did your compensation plan correctly. So same thing with a buyer. And then I was just going to talk about, I don't know where we're going to segue in terms of, I know we're starting to run tight on time around improving gross margins, but
let me touch on that last topic just really quick on the earnout, because again, we deal with this all the time. The buyer, I don't care who they are, makes more money from those customers that they're buying from you than you do under an earnout. They want to keep those customers. It is a complete misnomer that an earnout is something that's is designed to screw the seller. However, there are buyers out there, and we try not to represent them if we can help it, who don't really structure earnouts properly. So it's really the structure and how the earnout's done as opposed to it's an earnout. Again, you got risk issues. So again, it's probably a whole webinar on that, but I'll shut up now. Go ahead, Scott.
No, I'm good. Whatever Brian wants to do for transition.
All right.
Go ahead, Brian.
I'll take a couple of questions, and those of you that are asking questions, we'll hang back for a couple of minutes even after answering some questions. But if we don't make it to your questions, we'll make sure that we follow up and email you directly your answers. But there's a couple of interesting ones that have come in. One of which is, if an MSP sell side is running 100% virtually and not paying any rent, do you add in a reasonable amount for rent or leave it at zero expense when evaluating their financial statements and EBITDA, or do you make an adjustment?
It depends, I think is the easy answer. If it's working well virtually and we could see a path to that and we want to continue that, then we wouldn't necessarily doing that. If we talk to the seller and like, yeah, we've been doing this virtual thing for a year and I've heard this a couple of times, it's not really working out. We did much better and the financials were better, and when we were all together, then yeah, we would probably say, well, there really should be rent expense. It's kind of that reverse add back concept that Scott was mentioning earlier. So I think that heavily depends on the way the business is operating.
I think all the buyers I know would say the same thing.
Rick, a couple of questions just coming in about the general state of the market right now, given COVID. How are you seeing things going? Or is it going, how do you forecast 2021? Do you think it's going to soften, get hotter? Quite a few questions all around that.
We're having the best financial year in the history of Cogent ever in 10 and a half years. I think this whole COVID thing has proved that the IT services industry is an essential industry. I have seen very, very few companies that were adversely affected. If they had a customer concentration in some of the highly affected industries, if all your customers were cruise lines and hotels and airlines, well, you probably were adversely affected as a business. But if you didn't have customers that were really susceptible to being affected by COVID directly themselves, everybody we're looking at is doing really well. Most of the IT companies we're seeing are doing very, very well. There was that tear on fire period between March and end of April. Everybody's running around trying to go to work from home. Everything was going on with PPP, and people just weren't focused. But boy, that was it. That was kind of a blip. And we're as busy now as we ever have. I've got 7 deals post LOI trying to happen in July and February. January and February. So that's a testament to how strong the business is right now.
And I think COVID aside, we're still as an industry up against a serious demographic issue. Is that most of these businesses, these MSPs, were started by boomers 20 years ago, And those boomers are approaching their 60s and in some cases 70s are starting to think maybe it's time to hang it up. And
That's
a predominant number of them still own that way, and not a lot of second generation people inside the business that are willing to step up and buy it. I think we're just going to continue to see that increase. That's at least our experience.
And again, from a buyer's perspective, it's still a bit of a seller's market. If you're a seller, it's still a bit of a seller's market, everybody. Your company's very valuable if you run it right. And hey, buyers, the companies are very valuable and you got to buy them right. And so, I haven't seen that change. I'm also seeing a lot of other activity from other of our, basically our competitors are other buyers in the space, for what it's worth. And we're seeing a lot of activity from a number of, other buyers are also getting stuff done. So it's not just us. I think it's a very vibrant market right now. And I think it will be through 21 for sure.
Very good. Well, just for time's sake, let's go ahead and transition over to the balance sheet content. And again, keep the questions coming. We'll work in some questions at the end. We'll all hang back to answer questions for a little bit longer. And if we don't get to your questions, we'll respond back to you directly. Oh, Scott, it looks like you're muted.
Scott was trying to say was
perhaps, or maybe we should hit a couple of those questions while Scott's working that out.
Yeah, I think that's fine.
Why don't we hit a couple of questions while Scott gets his audio going?
Someone else said they're also having a fantastic year due to COVID, but we're concerned about future customer hardware sales as everyone put them into 2020 for remote workers. We talked to an M&A company that was recommending sales this year as future years may be softened up. Will this be the case for other regional MSPs, and will the flattening cause a dramatic drop in M&A valuations?
Can you guys hear me?
Can you go first, Patrick?
We hear you now.
Now we can hear you, Scotty. Let's answer this question first. Go ahead, Patrick, you go first.
Yeah, I think that I guess we saw somewhat of an increase in terms of gear needed to adapt to work from home, but that's a pretty small portion of our business and most MSPs that we look at. In terms of the management of things, I don't think things got any simpler. I think we could all attest that, particularly at the beginning, it got a lot more complicated, and we had home printers and home networks. And I think with the advent of more of that continuing, yeah, do I think hardware sales may have been artificially up in 2020? Yeah, maybe. But I still think that I don't think that's going to make a big difference in valuation. That product has such a very small portion of any valuation that we do of a business. So I think that there's some risk of that going back down, but I think our core services, maybe potentially, that there's a higher demand now than there was before.
I'll give a quick follow-on answer to that too. So when you're looking at hardware product sales at a product margin of, let's say, 18-20%, average is about 18-20%. Those numbers we were using previously are about right. Even if you're a straight bar and you sell virtually nothing else, all you do was hardware sales, the valuation is still about free cash flow. So if your sales are going to be less strong in hardware, it doesn't really impact the valuation per se. It's the total amount of money that you would get for the company from a purchase price perspective, because obviously your free cash flow would be lower. So again, you just got to always be thinking in terms of free cash flow. If it's going to impact your free cash flow, it's going to impact your total purchase price. And I like to stop using the word valuation a little bit here. I know this is all about, but it's really purchase price, right? We're not trying to value the company to go to court. Well, some people might be. I hope not, but that happens. But it's really about purchase price. So what you're trying to do is make sure that your free cash flow is manageable. I mean, you got a good story there. I mean, hey, all my guys ordered all my stuff this year and it changed your delivery cycle and your refresh cycle, well, then just be cognizant of that and be able to bake that into your projections, right?
Very good.
Go ahead, Brian.
I was going to say, Scott, if you want to take off through this, then
it's always good to be on a little bit of time. Hopefully, I won't talk too fast, trying to get this information out. But what we wanted to talk about, we had a $3.2 million deal, right? but there's also the issue of what do we walk away with as a seller in terms of cash. So we want to show you what impacts that, but also talk about some gotchas. So, we have these 5, I call them 6, pretty important accounts: deferred revenue, cash, accounts receivable, liabilities, assets. And then what can also be very important are things that should have been on your balance sheet that aren't on your balance sheet, that you're not even thinking about, that's going to impact your cash. So if we talk about deferred revenue on the next slide, so hopefully everybody knows what deferred revenue is. This is something that I have set in ConnectWise vernacular, a down payment for, that I still have a liability to deliver that service. It's cash I've collected, again, as a liability. Where do we see some of that? Block time agreements, if you're still selling those. Down payments on projects that you still haven't finished. Annual prepaid things. So if you're buying, or if somebody's paying for the whole year for cloud, but you still have to pay for it throughout the year on a monthly basis, that is all money that is, I guess, for lack of a better term, you actually owe back to the buyer, right? You're not literally writing a check, but in the calculation, you're going to write
10-second interjection.
Absolutely.
You are the custodian of that money for your customer. It is still your customer's money. It just happens to be in your bank account because you haven't performed the services yet.
Yep. And that's actually probably a better way of doing that. But we certainly see deals. I'm not going to go, if I ask Rick to give some examples, we'll only get through one more slide. But I do know one example, somebody that had an entire deal. You start going through due diligence, and the seller didn't realize that the $100,000 deferred revenue is money that, well, he was a custodian for that client, and that was going to be $100,000 less out of the deal once they were done. So pretty critical. If we go to the next slide, cash, I guess that's pretty straightforward in the sense that if you're doing a asset purchase, meaning Aldridge, if they're doing it, is purchasing the assets of your company, but you still own it. Generally speaking, the seller gets to keep all that cash, right? So if you have $1 million, you did a $3.2 million deal, you're walking away just from that with $4.2 million, okay? Is that good that you had $1 million in your business and you didn't need it? Not necessarily. What you really should be doing is making your cash work for you. Either it's more investment and grow that organization that you own, or stuff outside the organization. So if we move on to accounts receivable, this is much the same way. If you sell your business on February 1st, 2016, that is the date I sold to Aldridge, and I had $200,000 in AR on that date, that is still my AR, right? So assuming that I can collect it, that is good for me as a seller. Now, to run my business, I really should be running it on low AR, right? I don't want to float. I'm basically loaning money to my clients. So we really want to operate with low AR, but take that unused cash, that excess cash in the business. We want to pull it out and make other external investments, diversify, so you can properly use that money. If you can invest it, in growth of your company, by all means do it. But if you're not, it's not working for you. So
one more quick interjection before you roll the slide. So it's earned AR because you serviced it is your money. If you sent out a bill, an invoice for something that you didn't actually perform the services, that's deferred revenue.
That's right. Yeah, that would be AR that you hadn't yet collected on that deferred revenue.
I just want to make sure they understand it's got to be AR, real AR that you actually performed the service for is your money in a transaction.
This is where we would actually pivot back to cash, right? Cash, looking at our financials. So when we look at liabilities, right? High AP will affect you negatively, right? If you still owe that money on February 1st, you still owe that money. Where we might see that is somebody that sells a lot of product, particularly if they're using their vendors, right, to finance, right? They might even have had the cash to do it, but that's the way that they manage their business, so they can take cash out. They still owe the money, right? The seller still owes it. long-term loan. Patrick mentioned we don't see a lot of that, and we shouldn't. These businesses, unless you're doing something a little different, tons of hardware, maybe your own HAWs and things like that, you shouldn't have debt. And if you have debt, significant debt, then we need to change the way we're operating our business. It shouldn't. Again, I'm going to go kind of quickly because we're almost out of time. Short-term liabilities, they affect how these things look. And this is where we kind of get into, you have a liability, you say, you've got to take this, Aldridge. I say, I'll take it. I'm just going to discount your price, right? Or you still have to pay it, but nonetheless, it's affecting that cash. Are there any contracts, again, same thing, that either are not assumable or the buyer doesn't want to assume them? Those are pretty important too. If we move to the next slide, assets, straightforward, unbilled revenue. So on March 1st or February 1st, if I get to bill all my old projects, that's right at that point is an asset, so I get that. Inventory if it's worth something. So if you have 20 workstations that you're selling every 2 months on your shelf, that's worth really what they're worth. So that has value. Other assets, you'll often hear Brian and Paul at SLI talk about this. They're close to worthless on most of it. So be very careful about looking at your balance sheet with assets and thinking that somehow makes you super valuable in terms of what you can walk away with. Our last or second to last slide here, just some things to think about that aren't on the balance sheet. PTO, vacation, depending on how it's structured, you may still owe that. And so as a buyer, if they still have to give them vacation, you have to pay that back. There are issues, Rick brought this up the other day, that sometimes we want to make sure, even if the policy doesn't say exactly that we would owe that PTO, because now you basically went to work somewhere else. We still want to make those employees happy. So we need to talk about what's right for the employee and what's right for the deal. Block time agreements that you don't do as deferred revenue. I see this with a couple of clients. I have actually, it's not a bad thing, but if on November 1st you invoice for December services, that was technically deferred revenue when you did it. If they're paying on December 1st, it's not that big of a deal. That's what we often, but if you're collecting that money all through November for December service, and you did down payment, again, it's going to affect your cash. And how does this result? If we look at our last slide, this was, if we look at two scenarios where we had this $3.2 million purchase price. In the first scenario, we have lower cash, not necessarily a bad if your cash is working for you outside the business. We have low AR, which actually, again, is a good thing, assuming you're managing your business. We have pretty high deferred revenue. This is an area where we had a deal that fell through because they just weren't expecting that. And we have liabilities. We're financing our business through vendors, doing it maybe consciously. Maybe it was okay to do it, but just remember, it affects your walk away cash. In this scenario, we literally walked away with less cash than the purchase. In scenario 2, we went from $3 million to $2.9 million that we walked away with. Again, forgetting deal structure first, because we had a lot of cash in the, we had, decent, or very little deferred revenue, I think is actually a good thing. I don't think that always deferred revenue, if you're not managing your cash well, that you're getting from that is not a great idea. And most importantly, low liabilities. This person's seller away with a heck of a lot more cash. If you're going to this experience, think about these things so you don't have a gotcha. Also understand that it's not about the purchase price in terms of your cash, and at the end of the day, on a size business like this, your retirement, because that's what we're talking about is it's about fraud and all these kinds of things. Money and assets are about life security, and that's what that cash is. So that's it for that. I apologize for going so fast. We're actually 2 minutes long already.
No, I think that's all right. And we'll certainly be doing another follow-up event and probably dive a little deeper into this stuff because I think there's a lot of content there that we didn't really get to dive into. One question that's kind of timely, what about, are there issues with PPP loans that need to be considered before putting together a deal? Should we make sure the loan forgiveness is done before closing? Anyone have a comment there?
You don't have to. We're giving everything we've been doing this year has had PPP loans as part of it. There's brand new guidance about a week ago. There's some guidance that was in the beginning of October. I won't get into the whole thing. You can always ping me offline if you want some direct advice on that. I can free advice, no problem. But the SBA has very clearly said that if you've already got forgiveness, there's no issues. If your bank, we bank with Chase, we actually got our PPP SBA approval just yesterday here at Cogent. So just so you know, guys, they're actually, the SBA is processing stuff pretty quickly. At least for us. The bank itself has the option of allowing you to escrow the amount of money with the bank that you owe the bank, just in case the SBA doesn't approve you. And that's how the banks, makes them work, and you can close around that. So if there's no reason to really hold up a deal around PPP, there's good ways to structure with PPP included. There's nothing that should slow you down or stop you from doing a deal.
A couple of other quick questions that I think we have some fairly quick answers for. How much of a factor are termination clauses in MSP contracts? Patrick, you want to take that one?
Yeah, I think this is similar to what we said earlier. It doesn't really affect the valuation or the purchase price as much as it does the deal structure. If you've got 30-day out, if you have great contracts, but every contract has a 30-day out, this buyer is going to shift some of that risk. So in the way we do that is headed toward earnout. There'll be more in earnout because the client can leave at any time. So it doesn't necessarily impact the purchase price, just the deal structure and the risk profile.
I agree with that. That's right. All our buyers have said the same thing.
And you want to pay all that earnout.
100%, 110% would be great. Yeah.
Yeah.
Also, in the financial analysis, do you weight recurring for higher multiples than one-time sales, or are you more looking at trends and how it aligns to your business as the buyer?
Yes. Yes, MRR has a higher valuation than one-time revenue, but if you've got the same one-time revenue and you've got a good history over 3 years of having it, that again, I think the purchase price or valuation isn't necessarily negatively impacted because it's one-time revenue. That just might be an example of risk shifting as well.
I don't care about the revenue. It's how much cash flow does it make. I'm never going to pay multiple of any kind of revenue ever for any buyer that I know, including Patrick. So the idea is going to be how much money does it generate, and what's its gross margin of that revenue is more important. So once you understand the gross margin and some of the contractual issues and so forth, you're taking a sort of test on the entire sort of all of the revenue from a 100,000-foot point of view, not being too in the weeds on it. So you're looking at everything that comes from that revenue, the contractual relationship, how long have you had that customer, how likely is that customer going to stay, what kind of contract are they under, what's been their renewal history, all kinds of stuff goes into answering that question.
Very good. Well, thanks everyone for attending. I know we ran over a couple of minutes and there's quite a few questions that we didn't get to, but we'll make sure that we get answers back to you and also use that information to craft the next event that we do in this series. So appreciate it. Again, please take a couple of minutes to fill out that survey. There is a question on there that if you want to receive the Excel workbook that we just worked through, we're happy to send that over. Just select that when you do the survey. So thank you all and have a good day.
Thanks.
Bye, everybody.